Hello everyone, and thank you for clicking on the video. In today's episode, I want to explore two popular Chinese companies to see if there is opportunity in either of them, how they compare to one another, or if both should be avoided. And those two companies are the Chinese megacaps of Alibaba and Tencent. I have to disclose that I am a shareholder in Alibaba myself right now, and have been invested in following the company for just over 2 years now. However, with the bearish sentiment around Chinese stocks in general, combined with the massive structural reorganization of Alibaba that has been announced and it's currently undergoing, I thought it would be a good time to see if there's opportunity in one of China's other top companies and if it could offer a better or simpler investment than Alibaba now with its new reorganization. Remember, I am just a guy on the internet sharing his opinions. This is not financial advice, and you should always do your own research before making any financial decisions. Okay, so to kick things off in this video, I want to recap the characteristics we'll be looking at to determine if these companies could make for long-term compounders. The 7 qualitative checks I have decided to evaluate and consider when looking into a company are: first, gross profit margin over 30%, second, a high return on equity. I use a 5-year average between 15 and 20%. Third, a high return on invested capital, where I look for a 5-year average over 10%. Fourth, a debt to EBITDA ratio less than 3. 5, insider ownership over 5% to make sure management has skin in the game with me. 6, I prefer a free cash flow yield over 4%. And 7, checking to see if they are doing buybacks or paying a dividend. Let's dive into both Tencent and Alibaba side by side to see how they stack up in each of these items and get a general sense of the quality of each business before we go into assigning some price targets and potential return on each. First, we want to look at the gross profit margins and make sure they are over 30%. Starting with Alibaba, we see that currently it has a gross profit margin of about 37%. However, if we look at the past 10 years, we see that the gross profit margin has been compressing down from nearly 70% 10 years ago to the 37% it is today. When we look at Tencent, it currently has a gross profit margin of 42%. And looking at the past 10 years, the margin also dropped from an initial 60%, but has been holding steady in the low to mid 40% range for the past 6 years. Next, we want to look to see the return on equity and if it has averaged between 15 and 20% over the past 5 years, and make sure it is consistently in that range. For Alibaba, the average ROE for the past 5 years is about 12%, dropping below 10% in the past 3 years. The first half of the decade, though, it would have met this criteria. Then for Tencent, the average ROE for the past 5 years is about 20% and is consistently about 20%, except for this past year when it dropped to 3%. This looks like it could be an anomaly and would warrant further research into. The next metric is a 5-year average return on invested capital over 10%. Alibaba meets this criteria, consistently being above or about 10% ROIC. However, the drop from 26% down to 10%, and then it holding steady around 10% the past 3 years, may indicate that this is the expected long-term average, not the 25% plus seen earlier in the decade. Looking at Tencent, the ROIC has been weaker than Alibaba, more consistently around that 10% mark, and dropping just below 2% this past year. Then to check the health of the balance sheet, we want the leverage ratio of net debt to EBITDA to be under 3 times. Alibaba passes this check and has consistently maintained a net debt to EBITDA ratio around or below 1. Tencent has historically had a slightly higher leverage ratio, but still under that 3 times until this last year where it creeped over, making me think there may have been an acquisition done with some debt. Then looking at insider ownership, this check is a quick one as both Alibaba and Tencent have both well over 5% of the shares held by insiders. Alibaba has just about 20% of shares held closely, and Tencent has about 35% of shares closely held. The 6th thing we want to check for is that the free cash flow yield and what that is for the company, and we prefer to see this around or over 4%. Alibaba currently has a free cash flow yield of about 12% and has historically maintained a free cash flow yield around 4%. Tencent, on the other hand, has a free cash flow yield of over 5% right now, and historically has had a free cash flow yield of about 2% to 3%. Either way, right now, both have a free cash flow yield over our desired 4%. Last thing I want to check is if the company is doing anything extra to return capital to shareholders, either in the form of buybacks or a dividend. When we look, Alibaba has been repurchasing shares at a rate greater than share-based compensation, reducing the number of shares outstanding. Tencent, though, has actually been slightly dilutionary, but they do pay a small dividend. So to recap the 7 characteristics and how each company meets them: gross profit margin over 30%, both companies pass; 5-year ROE between 15 and 20%, Alibaba fails and Tencent passes; 5-year ROIC over 10%, both companies pass; debt to EBITDA less than 3, I'm going to give both companies a pass here; insider ownership over 5%, both companies again pass; free cash flow yield over 4%, both Alibaba and Tencent have free cash flow yields over 4%, pay a dividend or buyback, I am going to give Alibaba a pass here and actually give Tencent a fail, as even though they do have that dividend, they are still slightly diluting shareholders at the moment. Alright, now that we have some general qualitative sense of how the companies stack up, let's put together some rough initial price estimates and get a ballpark on potential return to see if either of these companies warrant digging deeper into. Taking an earnings-based price estimate of about $235 per share for 10 years from now, and a free cash flow yield to equity estimate of about $180 per share, I get a weighted price estimate of about $208 per share for Alibaba 10 years from now. When I model out estimated free cash flow to equity over the next decade, take the market entry price of about $90 per share, and then our estimated exit price of about $208 per share, I get a rough estimate for an internal rate of return of 15%. Then, when I put together a quick earnings-based estimate for Tencent based on EBITDA growth and enterprise value to EBITDA ratio, I get an initial estimate of about $425 per share. When I do an estimate based on free cash flow to equity growth and long-term free cash flow to equity yield of 17%, I get a price target of about $85 a share 10 years from now. Weighting these together, I get a final price estimate of about $235 per share in 10 years. With an entry price at today's market price of $45, the next 10 years of modeled free cash flow to equity per share, and an exit price of $235, I get an internal rate of return for Tencent of 42%. Now, pump the brakes, I would definitely need to dig deeper into that earnings-based estimate and do some deeper research into the earnings of the company, as it is probably skewing the total price estimate here. So what is the conclusion when it comes to Alibaba, Tencent, or neither? First, if you are not comfortable with or understand the geopolitical risk with investing in China, both these companies should be an immediate pass for you regardless of the potential return. If you are comfortable with the risks involved in China and want to dedicate the time to understanding them and each of these companies further, I think both of them could warrant further research, as they do both show potential of being quality companies. What do you think of Alibaba and Tencent, or investing in China in general? Comment below and let me know. Thank you for watching.